The triple net lease structure represents the contractual backbone of institutional real estate, specifically designed to convert physical assets into bond-equivalent yields by eliminating the operational friction inherent in being a landlord. In a traditional gross lease, the landlord remains responsible for property taxes, insurance, and maintenance. The NNN architecture reassigns these three nets to the tenant, creating a passive income stream backed by corporate credit rather than property management intensity. This structural shift is currently driven by a demographic rotation as retiring investors move from management-heavy assets like apartments into mailbox money structures. Market data from early 2026 highlights this opportunity, with single-tenant net lease cap rates reaching a 12-year high of 6.80%, while transaction volumes are projected to hit $36 billion. This window is further incentivized by the One Big Beautiful Bill Act of 2025, which restored 100% bonus depreciation, providing a tax advantage sovereign debt cannot match. The physical moat surrounding these assets is defined by specialized footprints and supply scarcity. Unlike generic office spaces, NNN properties like quick-service restaurants or medical facilities are customized for specific tenants, including unique drive-through configurations and parking ratios. This customization creates high re-tenanting friction, which paradoxically protects the investor by making the site indispensable to the current tenant. Current inventory reflects this scarcity, with listings dropping nearly 10% in the first quarter of 2026. Because construction has slowed due to labor and material costs, institutional buyers are increasingly absorbing quality inventory before it reaches the open market. This creates a disciplined environment where you are not purchasing a commodity, but a long-duration rent stream secured by a corporate guarantee. The mechanical core of the NNN structure is the optimization of net operating income, or NOI. In conventional real estate, NOI is a variable figure vulnerable to rising taxes and unpredictable capital expenditures. In an NNN lease, the landlord's operating margin is structurally fixed at 100% of base rent because the tenant absorbs all inflationary costs. This stability allows for precise long-term modeling, especially when combined with embedded rent escalators. For instance, data from Realty Income Corporation indicates that over 82% of its portfolio includes these clauses, which typically range from annual CPI adjustments to 10% bumps every 5 years. This architecture ensures that the asset is not just stable, but compounds in value over the 15 to 25-year initial lease term. Valuation in the sector functions as a spread instrument relative to the risk-free rate. As of Q1 2026, the 6.80% average cap rate sits against a 10-year Treasury yield of approximately 4.38%. This 242 basis point spread compensates the investor for the illiquidity of the asset. A critical comparison is the real estate wrapper arbitrage. A Dollar General corporate bond might yield 5.30%. But owning the physical Dollar General property at a 7% cap rate provides a 170 basis point premium plus depreciation benefits. Sophisticated investors prioritize this spread, recognizing that institutional anchors like McDonald's trade closer to Treasury parity because their value is derived from tax shielding and extreme credit safety. However, the bear case involves compression risk. As Treasury yields trend downward, institutional re-entry will likely drive cap rates back toward the 5.5% range, making the current entry point a tactical window for capturing market-to-market appreciation.
NNN assets are engineered for leverage because their contractually certain NOI satisfy strict lender underwriting. A standard $3 million acquisition at a 6.8% cap rate generates $204,000 in NOI. Applying 65% loan-to-value debt at a 5.70% interest rate creates positive leverage, where the cap rate exceeds the cost of debt. This amplifies the cash-on-cash return and maintains a healthy debt service coverage ratio, or DSCR. Lenders typically require a 1.25x DSCR, meaning the rent must exceed the mortgage payment by 25%. However, the maturity wall poses a systemic risk. With nearly $1 trillion in commercial debt maturing in 2027, assets financed at 3% interest are now refinancing into a 6% environment. To mitigate this, Institutional discipline requires a minimum of 10 to 15 years of remaining lease term to ensure the asset remains financeable through multiple rate cycles. The final layer of the NNN architecture is the aggressive tax shield provided by cost segregation and the 131 exchange. By reclassifying building components into accelerated depreciation categories, an investor can often claim 20 to 35% of the property's value as a deduction in year one. Under current law, this can result in an immediate tax recovery of over 25% of the deployed equity. When combined with the 131 exchange, which allows for the indefinite deferral of capital gains, the investor can compound wealth on a pre-tax basis. The rational verdict is that NNN is a core cash flow anchor provided the investor filters for high-quality credit and long lease duration. The primary failure mode is treating a lease as an ironclad annuity without modeling the go-dark risk or the impact of credit downgrades. True NNN mastery requires underwriting the tenant's balance sheet with the same rigor as the physical real estate.